Sitting here with John Howard, a senior consultation partner with Deloitte & Touche. John, thanks for joining us today.
Oh, not a problem.
I'll jump right into it. One of the main topics that we've heard so much about is the new standard on credit losses, ASC 326. What are some of the changes from the standard from previous guidance?
Yeah, I think it was, it was in response to the credit crisis. There were concerns that credit losses were recognized too little, too late. So the major differences in the new standard is we no longer have a probability assessment as far as to when you recognize a loss. Prior to this, it had to be probable that you already incurred a loss. Now, from the minute you become involved in an asset, you're estimating the expected losses over the life of that asset. So it's really, ultimately over time, you should recognize the same amount, but it's kind of getting it in the, on the balance sheet sooner and recognizing it in your income statement sooner.
There's a common perception that this standard is specifically or only for banks. Is that true?
It's not. I would say it's certainly impacting them the most, and you can tell they're the ones that are probably having the larger implementation efforts. But yeah, I mean, it does apply to all assets at any entity if your assets are at amortized cost. So whether it's loans, securities, receivables, but the impact will be bigger for entities that have longer dated assets like loans or longer dated, held to maturity securities.
There's an international standard, IFRS 9, that's actually in effect right now, came into effect January 1st, 2018. Have you heard anything about that? Have companies learned any lessons that you can apply to the FASB guidance?
Yeah, in fact, there has been a group that's kind of sent in a letter to the FASB of some of the mid-tier banks in the US right now that are asking them to reconsider ASC 326 and maybe do a hybrid of the IFRS 9 model. IFRS 9, generally speaking, when you have a new asset, unless it's really troubled when you become involved with it, when you have a new asset, you only recognize the losses you think are going to happen over the next year. It's only when it deteriorates that now you look at the lifetime losses. So it's maybe a little bit delayed recognition. It's maybe a smaller number on day one. And so I think the US banks are thinking, if we have to recognize lifetime losses on day one, that could be a big hit to capital. And so they've actually sent in a letter, and the FASB is going to discuss whether they want to go to kind of a hybrid model where maybe the allowance would be the same, but the amount that goes to earnings is kind of consistent with an IFRS 9 model of what would be lost in the next year, everything else would go to equity.
There's another new standard that affects financial instruments, and it's on derivatives and hedging, ASC 815. Can you talk a little bit about that? It's a voluntary standard, correct?
It is. Well, hedge accounting itself is voluntary. I would say, this is kind of the flip side of CECL. So ASC 326, people have been wringing their hands and asking the FASB defer, reconsider, think of other models. And we've got a transition resource group that's trying to work through issues. And even though it's not effective until 2020, you do have entities that are going through a lot of efforts and trying to make sure they can get ready. With hedge accounting, like as soon as it got issued, people decided, these are improvements to an existing standard to really make hedge accounting a lot easier to implement, a lot easier to just on a day-to-day basis track and report. It put a lot new hedging strategies on the table, and so this is one that people were actually excited about. So to the extent they weren't all tied up dealing with revenue recognition, leasing, and other things, like if they had the resources, they were jumping on board and trying to adopt this as early as possible.
FASB Chairman Russ Golden talked about phase 2 of derivative hedging. Can you talk a little bit about that? Have you heard about it?
Yeah, so there are a few issues. When they were doing these targeted improvements, there were a few issues that I think people felt like, well, we like where you're going, we'd like you to maybe go a little bit farther. And so like in the area of hedging non-financial assets, right now you can hedge forecasted purchases and sales. If you have let's say you have a supply contract, you can hedge contractually specified components as opposed to the whole price. I think they would like them to maybe go a little bit farther or consider an IFRS 9 hedging model where you just have separately identifiable and reliably measurable components, which would really help for even if you don't have supply contracts, just buying things on the market, in the spot market. And because a lot of times you'll buy at different locations, but the derivatives market is all based on a central location. So, is there always a NYMEX component to the purchases in Oklahoma and purchases, in Kansas? And so that's one area they're pushing. Another area where they're asking for maybe a little bit more is, banks have, mostly banks will be applying what we call last of layer hedge, and allows them to hedge portfolios of prepayable fixed rate assets. And you really can just hedge, like, let's say you have 100 million of fixed rate mortgages and you know that 60 million of them will be around, or you have a pretty good idea 60 million of them will be around for 3 years. You can hedge for 3 years just 60 million of that with an interest rate swap, and any prepayments or defaults come out of the 40 million you weren't hedging. The way it's written, you can do that with one derivative in one pool. Now they're saying, well, maybe we feel like there will be 40 million outstanding at least by the end of year 5. So can I do different derivatives on the same pool and kind of have a stacking process? They are talking about those issues. The board did direct the staff to pursue a few more things where maybe they'll make some further improvements.
Any other thoughts on financial instruments in general?
I would say with CECL, they're still, the FASB's done a great job as far as to when questions come in. We've got the transition resource group. They've been willing to amend the standard. They've been trying to be as timely as they can in addressing the issues as quickly as they can, because on that one, it's going to take a lot of time for people to implement. And so I think people want to do kind of a parallel run. So we may see some more things come out as they're starting to work through this in 2019 and kind of do what I'll call, the dry run, the parallel run before they have to flip the switch. And I think, with anything, once you actually start in and try to apply it, new questions come up. So I'm sure we'll still have more activity on that. We'll have probably, watch and see what happens with the FASB with hedge accounting. And then Sue briefly talked about they're trying to finish balance sheet classification of debt with current and non-current and simplifying that model too. But the only other big thing on the horizon, and this is a big ticket item, is liabilities and equity and trying to decide what's equity, what's a liability. Seems like it should be easy, but when you talk about things like convertible debt, is it going to end up as equity? Is it going to end up with them paying it off? Right now we have a lot of different models, or convertible preferred stock, but maybe it's redeemable. And so that's something that they've said they want to address. Honestly, they've tried to address that several times. It could take a while because there are some people on different sides of the fence as far as to how much or how little belongs in equity.
It sounds like some pretty complex topics.
Oh yeah, that one's a big one.
John Howard, Senior Consultation Partner with Deloitte & Touche.